His latest book is called Investing in the Second Lost Decade. He's the author of several other books, including Technical Analysis Explained. He's chairman of Pring Capital. Martin Pring joins us now. Hello, Martin. Good morning, sir. Thank you for joining us.
Hello. Thank you. It's nice to be here.
Martin, let's cut to the chase and let's look at our first chart, and then we can discuss around the chart. It's the S&P 500. It goes back to the beginning of the last century. It's inflation adjusted, and you're comparing it essentially to the Shiller PE ratio. And for our guests, the top half shows basically how the S&P has performed since 1900, and it looks at all the secular bear markets. And if we look at the far right, Martin, we're still in a secular bear market, aren't we?
Yes, we started in 2000, and in nominal terms we've lost about 8%. When you adjust it for inflation, we've lost nearly 29%. So it's been a pretty severe bear market in real purchasing power terms.
And if you look at the other bear markets, Martin, if we bring up the chart, I mean, the one at the beginning of the last century lasted 19 years. The one in the late 20s lasted 19 years. The one that started in the 60s lasted 16 years. This has lasted 12 years. How long could it go on for?
Well, I think it's certainly going to go along as long as the average of about 18.5 years. One of the things we have to bear in mind is these secular bears are caused by swings in psychology. And these aren't just day-to-day swings. These are major swings that take 10 or 20 years. And the Shiller price-earnings ratio is a great measure of sentiment. A lot of people look at it as a measure of valuation, but I look at it as a measure of sentiment. And because when it's at a very high level, what does that mean? It means that people are really optimistic about the future. And when it's down at the low level, the green line at the bottom of the chart, it's telling you that people are fearful and they want to be paid a lot of money to hold stocks. So right now, we're closer at 20 times earnings or so to a top than we are to a bottom. So we need to see quite a bit of a swing in psychology take place on the downside before we like to end this secular bear market.
So what's going to signal the next secular bull market, Martin?
I'm sorry, I didn't quite hear that.
What will signal the next secular bull market?
Well, I'm certainly looking for a low reading in the Shiller price-earnings ratio. Typically at secular bear market lows, dividend yields have gone up to 6 or 7%. They're currently around 2%. And valuation models such as the Tobin Q ratio, which measures the market on a replacement value, usually sells for 30 cents on the dollar. And the last I saw was about 80 cents. And typically at a bull market high, it's going to be $1.10 or something like that. So there's a long way to go yet.
Yeah, let's look at the second chart, Martin. This is the S&P 500 again. It's inflation adjusted, and you're comparing it to commodity prices. And you say the long-term trend in commodities are integral to your analysis. So what does this chart tell us?
Well, when commodity prices are very unstable, typically that's the cause of it. It reflects some structural problems in the economy, and that is very bearish for stocks on a long-term basis. So what you're seeing here is when commodity prices move up in a secular bull market, that's a very long-term bull market lasting 10 to 20 years, that's typically bearish for stocks. And we've been in a secular bull market for commodities since 2001. And I believe we're just about to begin another up leg in the secular bull market. So after some time, that will adversely feed back into equities again.
And how much longer do you think this secular bull market in commodities to last? And what sort of upside are we talking about here?
Well, we're about 11 years into the secular bull market in commodities, and typically they've averaged about 22 years. So if you're going to have an average, which you rarely do, of course, it will be at least for another decade.
And when we talk about the Federal Reserve pumping more money into the economy, Martin, you say we've just experienced, interestingly, a reversal in the velocity of circulation of M2 money supply. And that has implications, as you were just saying, for commodities as well, doesn't it?
Oh, very much so. I take a momentum of M2 adjusted for velocity, because central banks, as you know, have expanded their balance sheets tremendously over the last few years, but we haven't seen that show up in inflation yet. But with velocity starting to turn up, that's the time to get really worried about such things, and that's why I think that the commodity prices are just beginning a cyclical bull market as another up leg in the secular bull market, the very long-term bull market. And initially that's going to have a good effect on equities, but down the road, maybe 6 months, when commodity prices go up too much, interest rates also will go up, and that will be bearish for stocks at that point.
Martin, you've told us what's going to happen. You've said to me, and you've said in your notes, that a buy-hold strategy will continue to be a failed strategy. So in 40 seconds, I wish we had more time, what is our best strategy right now?
Well, I think a strategy that's oriented towards inflation hedge assets, energy stocks, commodities, gold, that sort of thing, hard assets, I think you'll do very well over the next year and a half or so. And I would definitely avoid bonds, because I think bonds are in the process of turning on a cyclical basis and on a secular basis. Remember, we've been coming down in yields since September of 1981, which is 31 years. And the average secular the average secular trend for bonds is around 27 years. So we're overstaying our welcome on this bull market in bonds.
Martin, thank you very much. We'll speak to you soon. Martin Pring, their chairman of Pring Turner Capital.